Watching this video will change the way you run your business. Have you ever found yourself looking at your financial statements and not understanding what's presented there? Have you ever asked yourself the question, what is actually going on in my business? Do you truly understand what's going on? Do you have true insight into the results and to the underlying causes why this is happening in your business? Well, in this video, I will discuss the three financial statements and how you can analyze them and how you can use those statements to truly understand what's going on in your business. So there is this storytelling phenomena working in the financial world, in the world of financial management, where people know that telling a story is one of the most powerful skills to acquire. The same in business, the same in running a business, in managing a business, in knowing what's going on. If you manage to tell a story, if you manage to know the story behind your numbers, then you actually truly understand what's going on. And the truth is that every business, whatever phase you're currently at, if you're still in the early phases trying to launch something, or even perhaps you're trying to optimize, trying to scale your business, there's always a story behind the numbers. There's always a story that you can tell as a business owner. And once you can do that, you truly understand what's going on. So welcome. My name is Luc Nicolas Velikutien. My mission is to help aspiring entrepreneurs and business owners build and grow a sustainable, purpose-driven business that is focused on growing their profits, that is truly, truly driven by purpose instead of only driven by greed. So welcome, let's get started. Today I want to dive into the three financial statements that you can be using to understand what's going on in your business. So let's start with the first one. There is the profit and loss, the income statement. They are basically the same thing. They are the same thing. Let's make things clear. The balance sheet and the cash flow statement are the two other financial statements that I will go into later. But let's start with the income statement, the profit and loss. And it is in sense a very simple statement. It shows you what revenues you had. So how much did you sell? Okay, so that's basically, I like to mark it green because it makes you money, right? So this is the part that actually makes you money. And then we have the expenses. And expenses is everything that you buy as a company. You buy products and services that you need in order to run your business, right? So that's why this is So that is why expenses are things that you buy and revenues are things that you sell. So when you look at the structure of an income statement or profit and loss, the structure of an income statement can be set up in two ways, but I won't go into detail. I will show you the most simple way, and that is starting out at the top. So we have our revenue or our sales. So that is what actually makes us money in our business, right? So this is actually what makes us money in a business. And then we have the expenses. We always start with the costs of services sold. So it's either cost of sales, you could have services, right? Depend on what you're selling, or goods. So that's depending on the type of company you're running. So imagine you're providing a service company, then we have the service part. If you're a manufacturing company, then we have goods, and in general they are called the cost of sales. So we have cost of sales, and the difference between the revenue and the cost of sales, all right, is your gross margin. This is an enormously important, is a very important figure to know and to keep in mind when trying to understand what actually is going on in your business. So ideally, your gross margin is a positive number. A very powerful tool that you could be applying in calculating the gross margin is by putting the gross margin into relative terms with revenue. So imagine you have 10K revenue a month. You have cost of services, which are 2K. So you have an 8K gross margin. So in percentages calculated, you always calculate you always calculate the gross margin or the cost of sales or any other income or P&L item as part of the revenue or the sales. So you start, if your revenue is 10K, this is 100%, then your cost of sales is 20% and your gross margin is 80%, which is obviously a very nice number to have. And depending on what industry you're in, certain margins will be higher in certain industries. That's just the way things work. So let's move on towards the other items on income statement. So after gross margin, we have our operating expenses. And our operating expenses are basically anything that is not part of delivering the service that is directly relatable to delivering the service, to producing the product. That is part of your operating expenses. And what I always like to do is to analyze which of the operating expenses is actually related to you providing that product and service, because that is directly relatable to your business operations. It isn't necessarily that operating expenses are only overhead. I'll give you some examples of operating expenses. You could think of rent. You could think of, for example, the salaries that you have to run your business. You could think of maintenance if you have an office building, or perhaps you could think of everything that is related to marketing and sales. These are all part of your operating expenses. So you might be thinking, then why is it so that the cost of sales doesn't include a part of marketing, right? If the operating expenses include marketing, the marketing helps to sell your products, to create revenue. So why aren't they included in the cost of sales? Because they are not directly relatable. So they are costs that you make, but you can't in theory it is possible, but in the processing of your accounts it becomes extremely difficult to allocate every dollar that you spend on marketing towards the items that you sell. So what they do is they just put everything as a lump sum in operating expenses. After operating expenses, we get our earnings before income and taxes, right? Sorry, for interest and taxes. So earning before interest and taxes. And what that basically does is, you know, what they also call this your operating income. So this is your operating income because it shows you how much you're actually making from your operations. After operating income, we have our interest expenses. So you could think of anything that has to do, that is related to the financing that you require to run your business. Perhaps you have a line of credit, you have a loan. Those are mentioned in interest expenses. And then we have our earnings before taxes, and then you have the taxes. Well, that isn't a really exciting story, so we'll skip that for now. But the most important elements to look at is your gross margin and your operating income. So how well is your gross margin doing compared to your revenue, and how well is your operating income doing compared to your revenue? So let's assume you have 5,000 operating expenses and therefore you have 3,000 operating income. This gives you 50%, so that gives you 30%. So let's assume you have 5,000 operating expenses. The question always is, how do you put into comparison that what you're looking at? The most powerful way to do that is always to compare relatively. So always compare relatively, because if you have, for example, in this case, a financial statement of year one, so this would be year one, if you would compare that to the same performance, the performance that happened in the first year to the second year, so imagine that you would you would place the you would place the financial statement of last year or of year zero next to it. So you know that you had 20K of revenue, but you had the same cost of sales, you had the same gross margin, you had the same operating expenses and the same operating income, right? So you know that is going very something is going very wrong with regards to the revenue, because you went down from 20K to 10K whilst everything remains the same. But what happens to your margin? Okay, so what happens to your margin? So this is the margin in year one, and this is then the margin in year two. So this is again is 100%. But what do you think that happens to the margin in year zero? So you have half of revenues. Instead of 80%, you now only have 40%. You have 40%. So I can show you the calculation. It's 8 divided by 20. Gives you 40% gross margin. So you actually, what happened in year two, or sorry, in year one, is that you actually doubled the gross margin, because with only half of revenue, you managed to achieve an 8K gross margin and the same operating income. So that is the power of using that relative figure, that year on year comparison. That is one of the most essential tools you could be using to tell the story from the way you progressed from year zero towards year one. So that is telling us a story that we can understand. So that's the first financial statement. And the second financial statement, which is in my eyes also one of the most essential items to understand, is the cash flow statement. So what the cash flow statement does is it looks at what flows in. So that is what we actually receive, and what flows out. So what we actually pay out, what we actually transfer from our bank account to our suppliers, our vendors, our refunds that we make. These are all cash outflows, right? And the inflows are that come from our sales, from compensations, whatever the case is. These are the cash inflows. Now, if you compare the financial statement, it would look in the following way. So the cash flow statement has three sections. We have section one, which is the operating cash flow. And from my perspective, this is the most essential part of the cash flow, because it says something about your operations. If you're trying to discover what the story is behind, for example, the fact that you have a lack of cash, or perhaps your cash flow management isn't the way you want it to be, then investigating the operating cash flow is one of the most beneficial things you can start doing. So the second form of cash flow, which is also part of the cash flow statement, is everything that has to do with investing. Okay, so if you're a company that, for example, invest in equipment, for example, in cars and buildings, whatever the case is, that all falls under the investing cash flow. So if you're trying to understand the story behind your business's operation, so why, for example, why is it so that my company is providing good services, but why are we having a lack of cash flow? Then I would always again advise to focus more attention on the operating cash flow. The investing cash flow looks at investments such as property, plant, and equipment. So did you purchase a new office? Did you purchase a new delivery truck, whatever the case is, and could also include, for example, items such as acquisitions. Okay, the third element of the cash flow statement is that has to do with financing. And the financing cash flow looks at everything that has to do with money. All right, so that has to do with financing. The word already says it. It has to do with that. For example, imagine that you acquired a loan, so you have debt, so you have debt repayment, repayment of principals, payment of dividends, purchasing of stock. So that is how the company is financed. How is it financing its operations? So let's give you an example of how a cash flow statement might look like. So there are basically two ways: the direct and indirect method. And I think for now I will keep things simple and just show you what it would like if you compare all cash in and outflows. So imagine you have, okay, so you have your cash inflows. So you have your sales, right? So you have your debtors, and this is then year one, right? So imagine you have 100K in year one. So this is your cash inflow, okay? Your cash inflow. And then you have your cash outflows, which are your operating expenses. And moving forward, you have your cost of sales. Okay, so this is a simplified example to give you an indication how it works. So you have your operating expenses, which are 80K, and then you have your cost of sales, which are 5K. Just to give you a very simple example. In this situation, you have a 100 minus 80 minus 5, 85 is 15, positive cash flow. So your cash flow in this situation is most definitely positive, right? So you have a 15K positive cash flow because you had 100K coming in, 80K going out, and 5K going out. So you have your 100 coming in, your 80 going out, your 5 going out, and having a 15K positive cash flow. So what lesson can we derive from this comparison is that in year one we had sufficient cash flow to support our operating activities. And that is a very important thing to know, because it means that your business can operate without requiring additional financing cash flows, without requiring, for example, issuing debt or issuing equity. So that's a very good thing to know. And the second step is then to analyze, for example, a year on year. So again, looking always at the percentual difference between year one, for example, and then towards year two. You could also, that's called year on year comparison. What you could also do is compare that from company one. So imagine business one compared to business two. So what you're comparing then is basically your business with another business, but in the same industry, to make comparison realistic. So you could do that from year to year, or from business to business. Now, the last financial statement is perhaps a statement that you would be using less, and that's the balance sheet. Well, the balance sheet, of course, is a very important statement, but I believe that in order for you to understand what actually is going on in your business, the financial statements give you more. The income statement, the balance sheet, and the cash flow statement give you more insight into actually understanding what's going on, because the balance statement is a snapshot. It is a snapshot of it's a snapshot of a point in time, right? And so that's in my eyes, the disadvantage, that you do not actually see the dynamic of period. So you only see a momentarily a very static image of what's going on in your business. And the balance sheet shows everything that you own versus everything that you're owed. So again, in red, everything that you're owed, and in green, everything that you own. And what do you own? Cash, maybe a car, maybe a building, maybe inventory. And what do you owe? Equity is actually an exception, but you owe, for example, debt. You owe, for example, you have to pay your creditors, your suppliers, your vendors. Just give them a name. So this is basically everything that you owe other people, right? And in theory, if you imagine you have a total assets of 1 million and you have a debt of 1 million, then you basically do not own any equity. So equity is something that I won't be going in much deeper into this video, but basically this statement shows us what we own towards comparing that to what we are what we're owed. So what do we owe others, right? And this is a good idea to use this statement to again compare this with the financial change, the delta from last year, or compare that to the difference, the delta of other companies. Okay, so other businesses. And I always recommend percentages because that is actually what cancels out the size differences between companies. So other businesses and year on year comparisons. Well, I think those were the financial statements that I wanted to mention to have a look at. And just to tell you that there is no rocket science, there is no highly complex thought behind these financial statements. It is understanding the basic line items in your cash flow statement, in your income statement, and in your balance sheet to try to understand what actually is going on in your business. You have to see it this way, that your financial statements are a recording, are basically a video recording. Or remember those devices that used to you could send encrypted messages with the I don't know what the crypt, I'm not sure what it's called, but anyway, it's a device that registers what has happened in your business for the past year, for example balance sheet, or for the cash flow statement or income statement for what happened in the past month, and it registers that and it shows you the facts. So it is basically a very honest overview, a very honest feedback for what's going on in your business. And I wanted to make this video because I saw a lot of business owners that I've met over the past year that struggled with actually truly understanding what was going on in their business. And the first big win they could realize, the low hanging fruit, was just understanding their financial statements and then creating a story, creating a narrative behind those figures. And the second step, of course, would be to have a chat with your employees to truly understand what's going on in the business, talking to key figures that know more detailed explanations why, for example, your sales are behind, why the expenses are so high. So that's the second step. But the first big win, like I mentioned, can already be achieved by just having a look at the financial statements which are at your disposal. I hope you found this video valuable. If you did, then please leave behind a like, leave behind a comment, subscribe, and if you want more videos like these, then just let me know. I'm open to making whatever you find valuable as my follower. I have something that I wanted to share with you, and that is I have a mentoring program where I help aspiring entrepreneurs and business owners grow and build a sustainable, purpose driven business. If that is something, if that mentoring or consulting is something that you might be interested in, then click the link below and you can plan in a free business strategy call where you can go through your current struggles, your current issues that you're having to see how I can help. So again, thank you for your time and I will see you in the next one.